Hey, it's Richard with Matthews Wealth Management. This is the year-end update that I'm going to be doing. It's early December. If you don't know, we've got twin girls on the way in December, so I'm knocking this out before I've had a chance to really dive into what happens in December. But a friend of mine was online and started looking at my videos, and I started looking at my videos from this year and read all the blurbs and said, wait a minute, a lot's happened. Should do a review. So I took a lot of the interesting stuff and I'm going to try to consolidate that into one video. So I hope it's not too long. If it is very long, then just skip it like a lot of y'all already do. So anyway, let's dive in. January of this year. I've got a couple of things I'm tracking here. The big thing, meme stocks, right? We had GameStop and AMC and Nokia and then there was this silver thing that was going to happen. And anyway, it was a weird time this year where just people realized that they could have a say in the world of finance. And that's great. That's cool. That's how it should be. There are winners and losers, and people wanted to go after the people who thought they had a loser in GameStop, and they wanted him to be the loser. And it just kind of shows you how our culture is right now. But yeah, it's had some lasting effect also, which is cool, and we'll see how that plays out in the long run. But yeah, if everybody remembers the meme stocks. Now, what I'm tracking here at the top on all these months is M2 money supply growth. So if you remember the year before, during COVID, we had all this $5 trillion printed out of thin air. Well, we continued that in the year 2021, so 2.49% in the month of January, and I'm tracking value and growth, the rotation that I've been covering in all of these. So if value is up, it's green. If something's down, it's red. So we had a good value month in January, and oil went up pretty substantially. And that was kind of the reboot of, we've got a new president, new administration. Granted, we still had the Georgia runoff that was going to determine whether or not the Senate had just a runaway vote without vice president. And yeah, it's been a weird year politically as well. But if everybody can remember January, fast forward to February, and we've got 2.49%. It's the exact same amount that they printed in January. They continued into February. And this is when we did our first reallocation of the year. So we started seeing some movement in the bond market. And it was February 24th. We reallocated all of the client holdings here. Silver did not make its big run. It kind of busted. I was upset about that because I wanted to see it, go through the roof. But it created a tear actually in the market of silver. If you were today to go buy American Eagle 1 ounce silver coin, first of all, good luck finding them. Second of all, you're paying a 50% premium above spot price, which is what we trade in paper. So when we're investing in like a silver ETF, strangely, there's no physical silver to back it anymore, which not sure how that happens, but they did amend the prospectus, so I guess that's legal. Yeah, no silver run, but there's that huge premium in the physical market. So try to go buy some coins, see if you can find them. They changed our M2, right? I was following M2 from the end of last year, and they said no more M2. We're going to call it M2SL and change up how we've measured it for the last 50 years. And then they went and amended the M1 and took out savings because we don't want to see how much people are saving. And I think at this time we were seeing a lot of stimulus money kind of being put back and invested into some of these meme stocks and some of the growth stocks. And that seems to be a trend as well. But the M1 and the M2SL were retroactive to May of 2020. So it kind of changed some of our graphs looking back. And anyway, that was why I really wanted to zero in on what's going on here with M2. So in our reallocation, we went very heavy on tips. We went very heavy on long-term bonds, which was a gamble. Interest rate risk really could have reared its ugly head. My bet was actually on a capital appreciation of that. If we kept dropping rates or, God forbid, went negative on rates. We really went heavy on commodities and value. So that's why we're tracking this value growth. Anyway, so March, we cut that in half. We cut our 2.5 down to 1.25 as far as money printing. So we cut back our inflation. And now we were talking about tax and spend, right? So So how are we going to pay for things? What's this infrastructure bill going to look like? We also saw that the 10-year Treasury spiked. It went through the roof. 1.76, I think, was the high point there. And there was some liquidity issues. There was no demand for bonds because new bonds were coming. The spending was going to be coming. I think at the time we were talking 6 trillion. Nope, that's in April. We clarified it to 6 trillion, but back then we were just talking taxes and spending at the same time, and that came from Georgia runoff. So this is my favorite quote of the month of March. Somebody said, if we can just keep printing money, why do we have to collect taxes? Still a great question. So anyway, we'll see how that plays out. April, the same money printing occurred. This is when we called it the infrastructure bill, and then we started saying, wait, what is infrastructure again? Oh yeah, human infrastructure. Well, that's different than bridges and roads. So all of this got mixed in. Green New Deal was in there. That's where that $6 trillion price tag came in. And we saw every single asset class go up for the month of April, which I think I said in that video is the definition of inflation, which it's December. We see it, right? There's inflation. This is when negative rates was a thing, and we saw oil do another big spike. So, but the month of April had a growth increase, even though we saw all the asset classes rise. More of the money went to growth than value, and that was the first of the year from the first three where it was value that got the preferential treatment. So, go into May. Hiring. We couldn't hire people. There's still a lot of hiring signs out there, but there were 2.2 million excess jobs than people that were on unemployment. So that meant even if we took everybody back into the job site, there were still 2.2 million jobs needed or needed to be filled. So that's huge. There's still a huge excess, but that reared its head in May. If you remember, capital gains was one of the big talking points of how we were just going to raise the capital gains rate. So this gets much worse down the road, but we were just going to go from 15 and 20 to 25% capital gains rate, and pay your fair share. That started back in May. Corporate income tax was also being talked about, that was going to go back up from 21, I think, to 28, and then they were talking about dropping it back to 25.6, and there were all these talks about corporate income rates. Lumber prices, everybody remembers that. Lumber prices through the roof, right? I remember a 4x8 sheet of 5/8 oak that I wanted for a workshop bench that I was doing in my shop was going to be like $65 just for a sheet. And so I still haven't built that bench, unfortunately. But lumber prices kind of came back down. They did come down, but they're still high, and they're going to keep going up. But that's just inflation. We started talking about deficit spending, and that was where the real talk of debt ceiling originated. It continues, and then we said that monetary repression was on the chopping block, or on we were going to talk about it, and that's basically inflation. That was where I really started hammering the inflation, even after we had been seeing all this money printing going on. But they did drop it in the month of May down to about 1%, so that was nice. It was a little less than usual. We bumped it back up in June to 1.25, and this was where it was very evident, from the value rotation in May back to the growth side on June, specifically June, July, and August. This was where all the new money that was coming out, we still had unemployment checks going out. Those ended around here, but all that new money was going into tech, right? So large cap growth, mid growth. Tesla was the main mid growth, but we saw all of those just take off, and it was just this direct funnel that was going in. And I think probably give some credit back up to the meme stocks and Robinhood and Interactive Brokers and all of them. But new money went into tech, so that was kind of a thing. As soon as money would be printed from here on out, we'd see the tech sector go up. So the reverse repo window, the Fed decided to pay 5 basis points for unused capital that banks had taken on, and they got some free interest that was also printed out of thin air. OPEC did a production cut, oil skyrocketed. Global corporate minimum tax was proposed, and Janet Yellen supported it. And Ireland said, no, we're going to keep our 12.5% corporate tax rate. And so that was the holdout. That was the big deal. You know, it's just crazy. Everybody hates a monopoly except for when all the governments agree to be one, I guess. July, small caps got hammered. I think there was a 2.5% loss across the board for small caps for the month of July. We didn't print anything. I was floored. I was amazed in that video to say, oh my gosh, M2 barely grew. But this is where we started talking about demand, because we're talking about unemployment coming back or dropping off, the possibility of stimulus. We got the child tax credit coming on board, and it's all meant to boost aggregate demand, which is just a Keynesian philosophy that's what makes the world go round, is people want stuff. Nobody's making stuff, and that was the issue. Is we got a hiring problem. We've got all these people on unemployment. We've got excess jobs, and nobody's got these capital good investments. Like we're not making stuff anymore. We're not even able to get things rebooted. People say supply chain. I think that's really misunderstood, but we really needed to be investing in capital goods instead of just funding consumption, because we were dwindling our supply of things, and we ramped that up. We said, well, let's use more of it instead of going back to work. And it was funny because I think in January, in that video, that was my thing, is it's time to go back to work, and we just never did it. This is where we said in Chicago, you were paid $51,000 a year to stay home and be unemployed. So that's a lot. I think, what is that, $26 an hour? I think is what it was. $26 an hour to just not work. There's a bad disincentive there. And 150 million people left middle class. That's half of the country that should have been middle class. They're gone, right? I mean, we've decimated the middle class here. But at least we didn't print more money in July. Moving on to August, if you go back to March, my long-term bonds had not hit, and I was frustrated in March, and I was like, well, I thought that was a good move. I thought I had it planned out. Well, in August is when it hit. We didn't print too much. We printed, about half of what we were doing, but tips and long-term bonds just took off. So this is where we made a ton. And this had to do with quantitative easing as well as infrastructure deal getting separated. You had the big deal, and then you had the bipartisan deal, or whatever you want to call it. But yeah, the debt ceiling came up, and Mitch McConnell was going to hold them to it, and then kicked it down to December. And that's tomorrow, by the way, but they've already voted on it. GDP was revised by all these big investment banks it was revised down by 67%. So our GDP was on target for a 9% growth year. And then here in August, they were like, oh, wait, maybe only 3. So yeah, they revised that. And the Fed stopped tracking GDP. They're like, we don't even care anymore. It's so bad. So here we decide that we're going to stop counting inflation with how we changed M2. Here we decided we don't care about GDP anymore. Like, this was a year of don't let anybody see the man behind the curtain. And I think that's actually the best metaphor we can do. This was when the IRS was going to survey every single transaction in your bank account. It wasn't $600 or greater, like the Patriot Act that said anti-money laundering is about, a $10,000 transaction must be reported. We're going to lower that to $600. That was all wrong. I'd never heard anybody say it correctly. But if at any point in the year you had $600 in the account, every single transaction was going to be reported, regardless. And if you had 2 kids, guess what? You had $600 from your child tax credit. So literally, it was just survey every single transaction, which I think is the theme. I think that's the goal of where all this is headed. But I think people pushed back enough, talked to their representatives or whatever, and said, we don't like this IRS surveillance. And it's been throttled back, but I'm hearing it's coming back up in some legislation down the road. We had the quantitative easing pullback saying that, the Fed's not going to be the buyer of last resort anymore for treasuries coming from Janet Yellen or on the secondary market. So this was when we started to do what we did in September. So in September, all classes absolutely tanked, except for oil. In fact, when I say tanked, starting on September 18th, which was the day after we did our reallocation on the 17th, completely lucky. I'm not taking credit. It was just cool. The sell-off, the S&P dropped 4.65% in 1 month, the month of September. So all y'all who get your quarterly statements and your monthly statements and all the client meetings that I've had, Y'all were like, hey, I lost money. Yeah, we all lost money, but you know, we didn't lose 4.65. That's what the S&P did. So all asset classes tanked except for oil, which was up 10%. That was a big time for that. And the fair share talk really started to ramp up. This was when you got the weird stuff like we're going to tax the unrealized capital gains, or we're going to eliminate the step up in cost basis when someone dies, so that the kids have to sell the house, give us some tax money, and then that house goes to BlackRock so they can rent it out to somebody. I guess I think that's probably how that would have worked out, but thankfully that stuff didn't get passed, and the infrastructure bill, I think that was actually part of the reconciliation, the budget reconciliation on top of it, which is still being talked about. So I mean, this stuff didn't disappear, but pay attention. This stuff matters a lot. We pay on average $17,211 per year in taxes, which is property tax, payroll tax, federal income, state income, gas tax, sales tax, whatever tax. We pay on average $17,000 a year on that. But then if you do food, utilities, transportation, and healthcare, we only pay $16,840 a year for that. So we're actually paying more taxes than basic living expenses. So I think we all pay our fair share. That's the big thing. Until we get to October. October, we float back down a little bit on the money printing after a high September. But now we're talking about inflation. Inflation was the key back in October. And I think the big push was to say that the supply chain is causing the inflation, which I think is exactly backwards. The inflation is causing the supply chain, because if you create fake demand by just printing money and giving it to people, you're going to have excess demand above supply, and therefore the supply chain is not sufficient. So we didn't stop ordering stuff from Walmart and Amazon during COVID. In fact, we increased our demand. So we're shifting our supply chains around to accommodate the new way that we do our economy. But we don't have the supply, but we have excess demand from inflation. We would have supply if people had demand from earning money for producing things through labor. We don't do that, so it's just out of thin air, which means we're just spending our supply. Okay, so that inflation was already there. It's now showing itself in a lack of supply because of a lack of production. I know that's a lot, but that's what it is. 61% of Americans pay no federal tax. Pay your fair share, y'all. 50% of people that are working earn less than $34,000 a year. There's the middle class, is gone. Inflation is good. You heard that in October. It's a high class problem. No, it's the exact opposite. That's the biggest tax on the lowest class, and they called it a high class problem. Ireland caved. They backed out and they said, yep, we'll raise our corporate tax to 15%. So that's on the way. I think there are 2 more countries, but they're smaller, so they'll eventually cave or just be out of it. And then real wages are down 6.1%. So as we have inflation and we have the wages dropping, it's not a high class problem. That's a low class problem. It's an all class problem, and there's no middle class to have a problem. So anyway, November, that just ended. So Jay Powell finally said, we need to retire the term transitory. It's just inflation, and told you so. That was in the last video I did. Thanksgiving was up by 8%. We have the $1.25 tree, 6.8 trillion Social Security gap. We got the lowest unemployment since 1969. That's good, right? Or it just means that we have the lowest participation of employment. That's not good, and that's what's going on. But if we want to celebrate a low employment rate, my goodness, just look over here. Don't look over that way. Jeez. 67.8% of workers pay more in payroll tax than they do federal income tax. So that's part to this, back to the Social Security problem of a funding gap there. Gasoline is up 58.9% on the year, and our debt to GDP ratio is 130%. And we went ahead and we printed another 1%. So the value growth, it was 6 and 6 is how I think this is going to be. We're 6 up on value, and I think this is going to be a down value month in December. We'll see. You can correct me if I'm wrong, but we'll see how this continues. I'm going to be MIA. I'll still be keeping up with stuff, but Not going to be in the office very much unless it's absolutely necessary, but it's been an insane year, and it's been a lot to keep up with, and to see how it's evolved over time, and the talking points, the narratives, and how people are thinking about it. I mean, it's just we're not talking about the actual problems. We're talking about the stuff that we can point fingers on. Unfortunately, we need to raise rates. That's on the table. I think that was today, actually, that there was a big sell-off in the last couple of days here that has been generated from the realization that rates will be going up next year, most likely in June, and they should probably go up quicker and sooner, but it'll cause issues. There are bubbles all over the place. As we've been doing, the 1 month, the 3 month, the year to date, you can see the bubbles, and they need to pop. I mean, popping is good. That's how we take the wasteful investing and the wasteful businesses that can't be efficient. That's how we get rid of them. That's how we create a good economy of good businesses that produce things at a fair price that people want. I mean, it's 101 stuff. So let's get back to that in 2022, and yeah, we'll hang on for the ride then. But if you got any questions, email me and I'll get to you when I can.